Welcome back to tape number 7. Here we're going to do some advanced strategies and the 5-minute success formula. Tom, you think they're ready for this?
I think if they've watched tapes 1 through 6, and they thoroughly understand the strategies so far, then they're able to dive into this advanced strategies tape 7.
Okay, we're going to show you stuff that we do. We also do it in our live seminars, but I'm going to start with the 5-minute success formula. Really what we're looking for here are stocks that are going to have big moves. We call these momentum stocks. First, the stock should have a price gain or loss of 30% or more. Let me show you what I mean. If a stock, let's say, closed at $10 a share the day before, and all of a sudden it's opening up at $15 a share, you've got a $5 gain, which is really a 50% move. What happens is there's a group of traders called momentum traders that will actually now jump into the market when they see a plus or minus 30%. Okay? You got to remember what we're dealing here with is fear and greed. Do you think that affects the markets, Tom?
Oh, every day.
You know, what people are trying to do is, you know, if you made a lot of money when you woke up, you're super happy, aren't you?
Oh, yeah, the emotional high, yes.
Or if you lost a lot of money, you're not very happy. So what happens is these stocks will typically get more momentum. Also, on the other hand, you've got a stock, let's say, on the downside. The stock used to be a $25 stock. Today it opens up at an $18 stock. You know, you might have a lot of people who are very upset about that, and they're going to usually sell into this position. Okay, so what we're going to look for is momentum. How do you find that? Well, we figured the 30% is a good trigger point because there's a group of people, traders, who just look for this because that's a big move. You know,
right.
That's almost a third of a stock price.
Also, I think I've noticed that when we get a 30% up or down move, the actual options prices are screaming high in volatility, so it makes some real good plays there.
Right, exactly. So the next thing is, remember, plus or minus 30%. The next thing is volume. You want to have enough volume that no one's manipulating the market. Yeah. No one would do that on Wall Street, would they?
Oh, absolutely not. No one would say, I wouldn't call you and tell you that I'm going to buy a stock today, and, and why don't you sell it to me at some absorbently high price?
Sure.
And, you know, yeah, you're right. You got to watch out for that stuff.
Yeah, let me kind of give you an example about that too. So, okay, at 300,000 shares, that's quite a bit of shares. Let's say I have a stock and I bought a dog. We call it a dog, means, you know, you feed it Alpo in the morning because, you know, that's all it deserves. I bought this stock at $5. It hasn't gone anywhere, and all of a sudden I decide that I want to go out there and sell it at $10. Can I do that? Well, I can offer it at $10. It doesn't mean someone's going to buy it. I call my friend Tom, hey Tom, I got this stock, let's manipulate it. I'm going to offer it at 10, you buy it at 10, now you have a trade at 10, okay? Remember, for every trade there has to be a buyer and a seller, okay? You know, it doesn't mean that this happens often, but it does happen, and you can see it in the news reports, right?
That's right.
You know, you saw, you know, I won't name any names here, but you can watch it on CNBC, CNN. Sometimes people are playing games with the markets a little too much. Next, you're going to look for news, okay? What is the catalyst? I like to call this the catalyst, which is the news reports, okay? What a catalyst is, you have to ask yourself, why is a stock up 30%? Or down 30%. Isn't that what's going to drive the stock in the future?
Well, yeah, exactly. The psychology of trading. You know, we know it opened up or down 30%. It's just a matter of trying to figure out maybe fundamentally or technically why.
Yeah. So there's a lot of reasons why stocks go up or down 30%. Let's go through a couple of those. First, earnings. Okay. Sorry for my handwriting, but earnings. Basically, we just reported bad earnings. Real earnings, and then there's expected earnings. Okay? You can have a lot of other things. Management changes. Correct? Give me a few, Tom. Product announcements.
Yep, and the one that we know very well, which is accounting irregularities.
The old accounting irregularities.
Yeah, I made a mistake in the back of the store.
Right.
And now I need to report it.
Right, which is what we could do in our own checking accounts. There's not enough money. It must be an accounting irregularity here,
That's
right? Anyways, so
let me just say this too. For the first two, earnings and expectations, you can find this. You know, now we have the ability to actually see this on a chart.
Yep.
Where before we didn't. But if you go to our website, Optionetics.com, you put a chart in, and you'll see the earnings reports where you'll see a triangle going up, meaning the earnings met or exceeded expectations, and a triangle going down, meaning that the earnings did not meet expectations.
Right, exactly. How about if things like that, you got the earnings, expected earnings, management changes, product announcements, accounting irregularities. How about FDA approvals, disapprovals?
Yeah, that's right. And for the this is for the drug sector. For those of you that have not heard of this before, and basically the FDA can make some major, just with their one decision, can make some major impacts on medical stocks and drug stocks.
Yeah, exactly. And let's throw, what else could there be? Let's think of anything. Is there anything else? Well, how about no news? Let me throw it over in this column. No news means that nobody knows yet. Is that a good one to do?
Oh, yeah, absolutely, because it really it creates a very big bubble in implied volatility, because not knowing the news is actually worse than knowing something, because at least if you know something, that bad news is out and the stock's gonna make its move. But not knowing the news, the stock might actually sit still, and that could cause fear into the options traders, which really balloons up the prices.
I mean, if a stock's up or down 30% and there's no news, everyone's like, what's going on here,
That's right.
Not that someone would ever try to trade before any important information ever came out.
Of course not.
As you can tell, I'm a little cynical sometimes.
That would be unethical.
Oh, yeah, you can't do that stuff. All right, anyways, so as you can see, here's a list here. Let me add one more, because I do like the last one called takeovers, okay? We've all heard about the famous takeovers. All right, in fact, let me go to a new page for this one.
Well, actually, there's two types of takeovers, George, and I think you're going to cover those right now.
Yeah, two types, takeovers. You've got friendly, and last but not least, hostile. Okay, which one do you think you're going to make more money on?
Well, the friendly one is just too easy. I mean, everybody knows it. You and I both have companies, and you're going to take over my company. We're good friends. We come to a real good agreement. Well, what's going to happen to the stock price or the options price? We all kind of already factored in. And so I'm going to say hostile.
Okay. You don't make money in your friendly takeovers. What you want is hostility. Not in your marriage, but in your takeovers, it's good. So, so basically what you want is someone saying, you know what, before you buy our company, we'd rather destroy every piece of equipment we have.
Right. I remember one of the companies, Best Foods.
Yep.
Everybody was Nabisco was trying to take over Best Foods. There was a company in England that wanted to take over Best Foods, and they just started ratcheting the price up of how much they were going to pay for it.
Sure,
and Best Foods is sitting there like, we don't even want to be taken over, but all of a sudden their stock price is now double what it was just a couple weeks ago. So,
or, before, if they own a lot of real estate, before you buy us, we make sure to burn every property we own. That type of thing. That's where, because what happens is in a hostile takeover, typically the price will first jump to a certain price. Now what you have is a lot of hostility, and the board of directors for the company being taken over is going to say, that's, you can't pay us that. That's not good enough for us. And then what happens is they're going to have to bid the price up, usually. Or what happens, they bring in, what's called a white knight, someone else to buy them, and the price usually continues. Now, the good part if you're trading options is sometimes these things fall apart, right? And if a stock started at 25 and it's now at 50, if you put on an options position, sometimes this thing falls apart and it goes below the 25.
Yeah, the one that comes to my mind is the GE Honeywell deal that just recently was GE tried to take over Honeywell, and it just for one reason or another the deal didn't go through, and Honeywell is actually trading lower than it was before the rumor started.
Exactly right. So news is very important. Just to review where we are, plus or minus 30%, 300 shares traded. Look for news. Next issue is it's got to be an optionable stock. The reason you want to play the options is because you have less risk than playing the stock. You can play the stock, some people have, but boy, these things move big time, and you could be underwater real quickly.
Yeah, George, for the viewers out there, do you trade any stocks that don't have options on them at all?
Nope, not at all.
Okay.
No.
Neither do I.
When I first started, I figured, I can play any stock, but no, I realized you make your money with options. Remember, because we're doing the optionable stocks because of the main reasons you've learned. Starting from tape number 1, we're going to look for lower risk, higher reward. Okay? And when you're doing a momentum stock, let me tell you, these suckers can move pretty big. So you got to be really careful, you know, because you may think something's going to continue to the upside just because it went up 30%, but it can break down also 30% too. So you got to be really, really careful, and that's why we're going to do low-risk strategies when we're doing this stuff. However, it's fun to do because, you know, this is where the excitement is.
That's right.
And if you focus on looking at stocks every single day that are up or down 30%, there's a lot of action in there. The next thing we like to look for is something called block trades. What a block trade is large numbers of shares trading, say 5,000 shares at a time. Now, this is hard to get in a lot of places, but you can certainly get it from your broker, etc. But I don't spend a lot of time on that. Primarily, I used to spend more time, but now what we have is we know that if there are 300,000 shares trading, there's a lot of blocks at least.
That's right.
So we'll focus. The block trades isn't as important as going to the 300,000 shares.
I think another thing that our viewers can do is if you go to our website at optionetics.com and you go to bring up a chart, okay, click on the market data tab and you'll immediately see what's up and down 30% or more.
Yeah,
okay? That's a real easy way to do it. Second thing you want to do is go to a chart that you like that's up or down 30%. Take a look at the volume underneath of it. It's going to be in red or green blocks. Yep. Okay, and the green blocks basically means there are more buying going on. There's more upticks or buying than there is selling, and the red volume bar means there's going to be more selling than there is buying.
Yeah, and we're going to actually look at that a little later. So, so really, the next thing is after you know, you want to make sure there's enough traders in there playing. You're going to next try to figure out which strategy is best, which Optionetics strategy is best. Let's review some of the strategies you learned before this tape. Let's go through a couple. If you're basically trying to catch a market on the upside, okay, which is a plus 30% mover, okay, you're going to try to see what other bullish strategies might work. In many cases, actually, we will, in some cases, buy the straddle. People will say, well, why are you buying a straddle if it's going up? And you expect it to go up. It's because these things move fast. And for whatever reason, this news may get disseminated, and all of a sudden it breaks down again. And also, when the stock is going up, actually volatility is coming down, so it's not a bad idea.
Here's a good example.
Remember, we did that in our seminar.
Yeah, and we did. We found one with when Sprint was being taken over by MCI.
Yep.
And what had happened with Sprint, it had exactly this chart that you're showing here. Yep. But it was a great straddle trade because the options implied volatility was actually going lower.
Yep.
A lot of times, and you got to look at the volatility, guys. You got to see whether it's going up or down. If it's going up, then buying a straddle may not be a good idea. But if the volatility is actually dropping on a trade, you've got a real good non-directional trade.
Sure, exactly. And that happened with that company North Face. Remember the one we gave that example of before? That came up on our radar screen. It was a $15 stock. We were looking at the straddles, and they were $2 with 7 months to go, I believe. And all of a sudden, you know, everyone's running out to do straddles, and we thought it was going up, but it went straight down, and everybody made a lot of money. The guys who did the straddles. Secondly, call ratio back spreads. Remember, if you need to review what these are, just go back to that tape and watch it as many times until you wear it out if you have to. Okay, so back spread is a good way to do it because if you're wrong, you don't get hurt. 3, buy out of the money calls. Okay, and I'm going to put something else called cheap calls. Okay, because you don't want to buy anything too expensive here, primarily because, you know, we don't like you to risk a lot of money. In fact, you know, we want you to put as little money as possible to try to make a very good return. A
good point here on buying out of the money calls, guys, is that, again, you want to, if the stock is a low dollar stock, let's say it's a $15 or $20 stock, you know, putting a call ratio back spread on or putting a bull call spread on, as an example, may not be the right strategy just because the stock is so low and the options are so cheap. There isn't anything worth spreading. So, you know, George and I, it's not that we don't buy out-of-the-money calls. It's that we look for really good opportunities in which to buy call options.
Right, exactly.
It's just not the majority of our trading.
Yeah, typically not what we're doing. 4, sure, you can do a bull call spread. But, you know, in many cases, you don't really want to because you're limiting your rewards. So,
and it's a long-term trade, too. And this is a short-term trading strategy.
Yeah, I'm kind of going into the ones going down the list, and I'm kind of thinking I kind of like to straddle typically when I'm doing this. The ratio back spread, I'm going to do 90-day options or greater. I try to give myself enough time to be right. So I'm going to focus here. I mean, I can certainly do a bull put spread. You know, and I'm giving you the bullish strategies you guys should know, or at least understand what we're talking about. But, you know, once again, probably not going to do that. And if I did do that, I'd probably be doing in the money bull put spread. Okay.
Let me add one more to this repertoire here, George. And this is the one that I think has worked really well recently is calendar spreads. And this is an example where a stock moves 30%, and this will work more to the downside than the upside. If something gets hit really hard, 30%,
right.
a lot of times for the first 30 days, it's going to go nowhere until it gets, it'll go ahead and break out of its resistance or its support and then move to its next level. And that 30 days is an excellent time to suck in premium with a calendar spread or possibly like a butterfly condor strategy.
So really on the downside, in fact, I'll do the downside now. If I'm going to do the upside, this is probably what you're dealing with.
Exactly.
And if you're going to focus on any, the straddle's a great one to do because of this big move, But once again, Tom said volatility is the key. You don't want super high volatility when you're doing this. If volatility has dropped because this thing's moved up, that's a great thing. So,
right.
Okay, and probably the out-of-the-money calls would be second, and call ratio back spread would be third. The other ones I usually don't do very often on here. So what you're trying to do is have a stock move up. I'm going to give you the exit strategies in just a moment, but I want to go for the put side of this thing. If a stock now has moved down, and boy, you see this a lot, don't you? When a stock reports bad news, we call this the slinky effect. Remember the slinky you'd put on your, if it worked and you put it on your stairs, they would keep going down. Well, some stocks do this all the time,
Right.
Okay, so basically what happens is stocks reporting bad information, down 30%. That is not fun for investors, is it? They don't like to see that at all. So,
and people that actually think stocks are going to continue to go up and up, you got to realize something. Most stocks, and I mean the majority of stocks, it's sometime in that cycle, earnings cycle, economic cycle, whatever the cycle is going to have a pullback.
Right, exactly. And what happens is, I've seen tons of these. In fact, if I'm playing the 5-minute success formula, and I tell people in our class, you make more money on the downside than you do on the upside. Okay, given momentum for the downside is usually faster. If you guys have been watching the markets, it's usually faster down than it is up. People like to sell into rallies, but when it goes down, people don't want to buy into the falling stock. They'll sell short. Right? They'll drive it down faster. So
yeah, it's more of a panic effect on the way down, so it moves much faster in a much shorter amount of time.
Yeah, I remember we were in one of our seminars, and the ticker symbol that came up on our formula was MELT, M-E-L-T. I thought that was perfect for a stock just down 60%.
That's right.
So, and I just remember, there are many examples where we're in a class or we were doing this, and you get these funny ticker symbols and stuff. And the whole point is you look at the catalyst, and you want to see how far this catalyst will probably drive it. For example, a company just says, I'm going to report bad earnings, and you know what? I have no idea what my earnings are going to be for the future. Well, that's not good news for the
No, not at all. In fact, some companies even have good earnings, but based on their future outlook, that's what usually causes the price of the stock to move. And we see it every day where a stock that we look at and we say, wow, they exceeded their expectations. But then there's that word but.
But. The but. Remember we did that? The search? We did that once for the, remember we did a class and we were looking at some information. It all sounded great. And then Tom says, let's do a search of the news report and put the word but, B-U-T, in there.
That's right.
And then that's in there somewhere. If a stock is reporting good information, all of a sudden, it gets hammered. So, and then what we try to do is figure out how long that catalyst is going to be. For example, if it's FDA approval of a new drug that they're going to see for years and years and the stock moves up, that's probably a good thing.
Yeah.
If you see bad earnings, how long does it take bad earnings to turn around? Usually a lot. Accounting irregularities, how long is that going to take?
Oh, at least a year.
Take a long time. So you can you'll get a feel as to what the catalysts are. Now, when a stock is down 30%, like I said, you can use other strategies. The calendar spread, which Tom said, is probably one of the best ones. Because what happens in this kind of move? Volatility. That word volatility. Vol goes up, therefore you're going to get a volatility skew. Remember, the volatility skew is when the shorter-term dated options have much higher volatility than the backdated options. And what's that skew we're looking for, Tom?
Well, we're looking for at least 15%. Okay. And I can give you a recent one that I did. We had a stock that dropped 30% in one day. And I took a trade on this stock, and what I found is that I was looking at the at-the-money options. Not the at-the-money options from yesterday, because that was 50. The at-the-money options for today, which was 35 when the stock dropped from 50 to 35.
Right.
So I went ahead and bought the longer-term options and sold the short-term options and had a great skew. There was about a 50% skew between the front and back month. Now, this was one that actually did not work out. But what happened was it had broken out much sooner than I thought it was going to break out. I got out of the trade and lost a 1/16 of a dollar. That's the kind of losses that, if you're going to take losses, that's the kind of losses you want to take.
Right,
you know,
exactly.
win big and lose a little.
Yeah, and we tell people that losses are part of the game. I mean, you're not going to win every time, so you got to realize that if you're going to open up a store or open up a McDonald's, you have overhead. And our overhead is our, the losses. But what you need to do is learn from your overhead mistakes, so to speak. Okay, on the down move, how about buying out of the money puts? Okay, here I like to do the cheap puts once again. What do I call cheap? Less than $1.
And there's several of them out there.
Boy, and let me tell you, I mean, I remember during some of these classes where all of a sudden this news came out and we're looking at all the different ways to trade the stock. And I'm like, look, guys, with all these months to go, 6-7 months to go, buy a way out of the money put. It's cheap. Because remember, when you buy inexpensive options, let's say less than $1, their chances to double are much higher than buying a $10 option. So you can buy them inexpensively, but you can double your money faster.
That's right.
Okay? And not to say the probabilities are getting there. In fact, in most cases, I don't even look at the probabilities of that happening. I'm looking for the chances of me making some money pretty quickly. Okay? And so buying out of the money puts is good. A put ratio back spread could work, but sometimes that ties up a little too much money for this stuff. So when I'm doing these things, I'm looking at this and maybe a bear call spread, which is a credit spread. If you go back and remember the credit spreads, okay? Okay. Now these are just, I'm giving you the primary ones. You can do any of our bearish strategies, but I kind of let me put them in the orders I like. I do like the out of the money puts, and I like the calendar spreads being the two primary ones that I'm going to do there. So I'm trying to focus you on the ones for momentum stocks, because one of the things about a momentum stocks, and we've seen this before, I remember doing one of these ones. The stock's at 4, I get in it when it's at 11 the next day. Within a few days it's at 22, within a few days it's at 44, within a few days it's back to 4. So you kind of ran it right up, which we call a parabolic move.
That's right.
And then it runs right down. So you want to move quickly on these things. So let me kind of give you some exit rules too. In fact, so when you're looking at your strategy, as always, you got to place your order properly. Okay, which we've been going through order placement throughout the various videotapes. Let's go ahead and look at some exit rules. Okay, when a stock is going up. Let's say I bought a stock at 5. It's now at 20. What I look for is what's called a 20% retracement from new highs. Okay. Basically, all I'm trying to do is as the stock moves up, let's say it's 5, 10, 15, 20, but at no time has it moved 20% from the new price, then I'm going to stay with it. As soon as it moves 20% from the new price, I'm going to exit my trade. Okay? Just take your money and run. Nothing wrong with that,
Right.
Okay?
That's also called a trailing stop.
A trailing stop,
That's the best way to explain it, guys. Is as the stock moves higher, you're just trailing up 20% behind the high of the stock.
Exactly. Okay? Now, I'm telling you to exit, but let me tell you what an aggressive trader does when they're out there doing these momentum stocks. An aggressive trader will actually reverse their position. Okay? Not only will they exit the trade, they reverse it because they think it's going back to 5, which in many cases it does. Okay? It could easily continue down that way. And that's called a parabolic move up, parabolic move down. I suggest for those of you just starting out, just get out of the trade. Be happy you made your money, because sometimes...
And then go look for another one that's
exactly.
Up or down 30%.
Yeah, this is really aggressive, and, this tape is advanced strategies. Once you become a pro at this, then definitely, go in there and establish your exit strategy well in advance when you enter this thing, and practice. Practice makes perfect in everything that we do. Let me go in and do the opposite side of it, which is if a market's falling apart, it's got the slinky effect. What we're going to do is look for that 20% retracement from new lows.
So this is exactly the same as the up market, but you've just reversed the direction of the stock. Yep. That's basically it.
And at that point, I will exit the trade. Okay?
Good.
Okay? And let me tell you, people say, how often do these come up? Let me tell you, almost every day you can find one. Once again, if you're not going to sit in front of a computer, it's a little harder to do, but we're going to show you on our website how you find these opportunities. You're going to click a few buttons, and you're going to be able to scan a few things. It used to be harder when we first started doing this. Now we kind of simplified your life by going to our website. You know, the other issues here is, you know, remember this is more aggressive than a lot of our vacation trades. Vacation trades, you know, put it on, let it go. We're looking for action right now. We're looking for fear. We're looking for greed. We're looking for people interested in, you know, in getting out of trades, getting into trades. And boy, let me tell you, the market, that's what the market is. It's fear and greed in most cases. And using our strategies, though, you won't have to be fearful, and we don't want you to be greedy at least either. Right. So, okay. You know, so you're going to see, what we're going to do now at this point is we're going to go in and we're going to show you how to find these on our website. And we're back. And we're back with a computer.
All right.
We pulled a Houdini and woo, here it is.
Yeah, we're all set up. We got the Optionetics website up,
there
and we're going to show you how to scan for the 5-minute success formula.
It's their first view of our website, which, you know, we're going to kind of show you the tricks to the 5-minute success formula and show you how easy we made it. All you're going to do is go to the little tab we here called Market Data, and let's click on Market Data. And what you're going to get is basically a page that's going to show the 3 various markets, the Dow Jones up here, the S&P in the middle, the NASDAQ. You can see we picked a day that wasn't really bullish today.
Yeah.
And so what we're going to do, if you take a look at the middle of the page, it's very simple. You're going to see optionable stocks. There's a tab here that you can break down the stocks from NYSE, NASDAQ, Amex, but I'm going to keep optionable stocks there. And here's another tab you can click. You got percent gainers, percent losers, net change gainers, net change losers. What's the difference between net changes and percent gainers and losers, Tom?
Well, the net change is going to be the dollar for dollar change. So you're going to see the stocks that are, say, up $10 or $20
Sure.
for today. But, you know, if the stock is $200 and it goes up $10, that's only a 5% change.
Sure.
So that's going to be the actual net point change for the day to day.
Yep.
The percent gainers and losers, although may not have as much of a point change as the net gainers,
Sure.
their actual percentage between what the stock price was today versus yesterday could be exceedingly higher or lower.
Sure. So percentage is just percentage based on yesterday's close. Net change is pure dollar moves.
That's
okay.
right.
Well, let's take a look at today. Today was a fairly bearish day looking at the computer. What we're going to do is go to percent gainers, and I'm going to go ahead, get information.
And today was really, there was not, in this particular day, it was really a non-event day.
Yep.
There was not any persistent news that came out. The market just sold off after about noon, so, you know, who knows what we're expecting to find here.
Yep. In fact, looking at our screen here for percent gainers, remember we're looking for 30% gainers, and we're looking for at least 300,000 shares. Well, if you take a look at the first one, which is Netopia, if you can read it on your screen, 1.2 million shares. Does it hit the volume?
Yeah,
Yes.
sure did.
The price is $4.45. 121 is the change. 37% gainer. Well, that hits the criteria, but why might I try to avoid that stock?
Because it's less. It was a $5 stock.
It's a cheapo stock, so it's easy to go, you know, make a 30% move. So we don't like to do stocks that are, you know, less than $5. You know, even though they may make a big move, it's probably not going to happen. Let's look at the night one, COM21 Inc. Okay, the percent gain is once again 30%, so we're over 30%. But what's the problem here?
Yeah, $1.44.
It's a $1.44 stock.
It's less than a Happy Meal.
Yeah, exactly. Right,
and it did hit the volume leader just on the just went over the mark. But you're right. I mean, if the stock's less than $5 a share, if you're not excited about it, buy the stock.
Yeah, exactly. It doesn't make a lot of sense to do a lot of the other things. So what you can see here, there's not a lot on the percent gainers. What I want to kind of show you right now is you can get the chart of that stock. You can get the news, and you can get what's called the options chain, which is all the prices of the options right on our website. If you hit the news, you can dig in pretty closely into all the information. Isn't that true?
That's right. And then also, let me remind you all that this data that you're seeing on the screen, if you pull this up during the market day, it's going to be 20-minute delayed. So you're actually going to be close to real time. And, you know, real-time options trading, you know, I think being real-time and being 20 minutes behind isn't actually that much different at all.
Sure. Yeah, I suggest you look at this if you're going to be doing the 5-minute success formula, you know, at least 3 times a day. Look at the beginning, the middle, and the afternoon, because things drop on and off or so. And you may want to put on your trades towards the end of the day in many cases because you want to see if momentum held. So I don't see a lot to play with the percent gainers. If this, for example, this Cooper Industries, which is a $60 stock, was up 30%, then I'd be excited about that, okay? Let's go ahead and we're going to look at now the percent losers. this is where there's bloodshed. This is where people lose a lot of money. And we're going to kind of see whether or not there's anybody who's lost 30% today. Okay.
And once again, George, what he did was basically just click on the percent losers tab and clicked on the Get Data button to get what you're now seeing.
Exactly. So what it's going to do, it's actually searching every stock with an option, and it's going to try to find the information of the stocks that have the biggest losses on a percent basis. So these are all optionable stocks, which means they have options, obviously. And as far as percent losers go, no one clicked on my 30% there. Close.
Surprising considering the market averages dropped like they did.
Exactly right.
So came off,
the first one, United Therapeutics, is down 27%, but let's assume it was down 30%. I'd probably avoid it again because it's less than $10.
Right.
You know, how much more is it going to go? It's got $8.95 left there. So once again, if you want to get the chart, you can click on the chart. If you want to get the news, you can click on the news. If you want to get the options chain, it's going to come right up for you.
Yeah,
okay?
Very easy to
20-minute delay, though, okay? Let's now look at, here's the net change. So really on the 5-minute success formula, plus 30, minus 30, there really wasn't anything to play with today.
That's right.
The constraint we found was that the stocks were too cheap or they didn't show up on the list. Why don't we take a moment and let's look at what the net change gainers are. These are the ones that made more dollar for dollar. And let's take a look.
And again, the net change gainers and net change losers, although they may have some high dollar amounts, it's not something we normally consider as part of our 5-minute success rule.
Right.
Because we're looking for percent moves, not pretty much net change moves.
But it can show you momentum stocks, though.
Yeah.
Right? I mean, it can still show you stocks that have good dollar moves, because maybe that's what you want. You want stocks that really move big. I mean, sometimes, I remember one time, you know, certainly in the past, where I saw bunches of stocks with $30, $40 gains in a day, which is ridiculous, you know?
Right.
And then you saw
because
30.
of the volatility spike, it's worth taking a second look at.
Yeah, exactly right. So it's not what we use in the 5-minute, but, you know, you may want to look at it. As you can see here, the first one, Cooper Industries, was up $6.24. It's only 11%, so it wouldn't be a 5-minute success formula type trade. Enzon, which is a $4 stock, was basically up $4, $64 stock. It's only a 6% move.
Yeah, not a lot of action here at all.
Okay. What you want to do, remember, if you want to look at what the catalyst is, which we talked about, go ahead and read the news. And if, for example, if it sounds too good and the stock's getting hammered, look for the word, what is that word? B-U-T, but.
That's right.
You know, which means that there's a disclaimer in there somewhere saying that the future maybe not be that good for that company. Let's look for the net change losers. These are the ones who lost more dollar for the day. Let's see who the winners are today.
The winners of the losers.
The winners of the losers. Here we go. Manhattan Associates was down $5. It's a $21 stock. So if you're bearish, you know, if you want to be bearish stocks and they haven't hit the 5-minute success formula rules, maybe you look at this rule. Isn't this a good thing to keep on your radar screen?
It is. Veritas Software, well, we published a bearish trade on this particular software company when it was in the 60s.
Sure.
Look at it today. It's down in the 30s. And this thing, you know, it just didn't look like something that we liked. It was showing the pattern that we were interested in seeing. And then if you view the information on our technical analysis video, you'll know what we're talking about. But that had a great opportunity to the downside.
Sure, exactly. Or, you know, if you want to look at, you know, net stocks or stocks that are going to go down in the short run, you can, once again, you can get the chart, the news, and the options chain there anyway. Right. So it's all the information here is available for you. Today there was nothing that hit our 5-minute success formula. So what do? We look for it tomorrow. Why don't we do a few more things, or at least while we're here, show them a little more about the website, Tom.
Okay. First of all, let me go back to the home page for a moment. I'm going to click on the tab that says Home. All the tabs across the top are going to take you to the different areas that we have on our website. Our home page is basically where everything kind of comes together. You know, because this is in a publishing type format, it looks similar to a newspaper. Yep. And what we have is we've got our front page here, and our front page is kind of the headlines.
Right, exactly.
So we've got headlines here, which is, we talk a little bit about a section called Learning Made Easy. We've got an under the radar section. We've even got a humor section in here from traders that have kind of gone a fall to you know, what's happening in different areas of the trading world. We have an area called Community Questions, which are basically information that our students or other traders may ask us, and that we turn into an article because it makes sense that if it's that good a question, then we want to be able to have an answer so that other people who may have had that question, can find an area where to get the answer.
Yeah, there's tons of articles, tons of information, which people don't realize.
There is. And the upper right-hand corner, I'm going to move the mouse over to it right now. There's an area called midday action. We actually have the morning, midday, and closing actions of the markets, and what are the big stocks going on, what's the big news going on in the markets, and how this is affecting the markets as a whole. Also, we have areas where we have a site, which is actually where our risk management software is. You would click in here to get to that. If you wanted to do a market quote straight from the front page, you could just click a market quote. You can get news on it, or you can get an options chain.
So if you want to look at Cisco, let's say you just put in CSCO, and then you can basically go over here, get quote, you can get information, you can get whatever you want from that page.
Exactly. Also take note that we have a market snapshot on here, so you can see the market at any time. And these indices are real time, by the way. They're not delayed at all. That's real time information. From the moment you click, it's going to bring back that tick at that time of the day. Obviously, if after 4 o'clock, you're going to be seeing the close of the day.
Exactly right.
Let's go to an area which is gained a lot. It has a lot of hits to it. A lot of people are jumping in here. Most of them are students. It's called our discussion boards. And basically, we have discussion boards that are broken down where you can log on and have a conversation with another trader. Maybe it'll be one of our traders. Maybe it'll be another student who's looking for answers to a question. And we have information from broker talk to different types of strategies. We have local option traders clubs, so if you're looking to get together with other traders in your city, you can get online first and go to our virtual traders clubs, and then possibly get together and have meetings. So we host this as well. And then down at the bottom, how about this? Market Outlook. We have George's Market Outlook. He updates this on a regular basis. We also have a place called Ask the Traders. So if you want to ask one of the traders about an article they've written, or you want to ask George or myself a question, all you have to do is come on in here and post a message, and we get back to you on a regular basis with these. Okay, let's move to another section which I like to spend some time with, and that would be an area called Traders Education. Basically, the Traders Education area is just an area where you're going to start to tune your information. Okay, we also have upcoming events. All right, we can get in and know where our seminar information is. We have an area called My Portfolio, which is where the portfolio manager is. There's just so much stuff on here I couldn't possibly give it the amount of time it deserves, but I'm just telling you guys, check the website out. You'll definitely love it.
They just need to do some exploration.
That's right.
Now we're going to talk about advanced strategies. You've been seeing a lot of different tapes. Now we're ready to go even a little further.
That's right.
Okay. First and foremost, we're going to talk about a collar spread. And then we're going to talk about synthetic calls and synthetic puts. We don't want to scare you at this point because it's really not as complicated as it sounds.
No, it's just a different way of managing risk.
Yeah, but we got to admit that we're showing them stuff that a lot of people never even learn. So
yeah, if I was a first-time viewer and I heard what a collar spread is, I would think it would be the collar on my around my tie.
Yeah, no kidding.
It's actually a way to protect your stock.
Yeah, exactly. So what we're going to try to do is show you the collar, which is actually a very advanced strategy used by institutions that want to protect their stock positions. And I know a lot of people out there probably said they wish they had protected some stock in the past, because stocks do have a tendency to go up and down quite quickly. So let's talk about what a collar really is. It's going to be, you're going to own a stock. In fact, let me kind of draw it out. It's a lot easier when I draw it out. We're going to basically have a stock here, and this is called your asset. Remember, your stock is just an asset. What we're going to then do is buy puts to protect. Okay, buy puts for protection. And then what we're going to do is sell calls above your stock price to pay for the protection or your puts.
And for those of you who have never done this before, make sure you realize this, for every 100 shares of stock, what George is talking about is buying one put for protection.
Right.
And then financing that position by selling one call.
Sure. Yeah, and there's two types. There's a protective collar and an appreciating collar, and we're going to do both of those here today. So, so really what it is, I like to use the analogy. Think of your car. Okay, your car is an asset. Now you have to go get insurance for your car, which you go out and get with Allstate or whatever company. You now have to pay for the insurance. So it's the exact same concept as having an automobile. So what I'm going to do is show you the basic concept. It's really not that hard as to why we would even do this. If you have a stock, let's say at $50, it's going back to my handheld. Let's say I buy a put option. Remember, a put option is really when you buy a put, you have a right to sell the stock to somebody. Let's say I buy the 50 put and I pay $6 for that. Okay? What you really have done is you have a stock, you have protection at $50 telling the people, hey, I'm going to be able to sell it to somebody $50, but I have to pay $6 for this protection. So if you did only this part of the trade, in fact, I'll just show you, break that up. Forget selling the call side, you basically have a stock with a protective put. And later on we're going to do the synthetics, which you'll kind of understand a little better then. So, which is what most people would do if they're going to buy protection. They're going to buy a stock, buy a put, and then the risk on this trade here is going to be the cost of my put, which is the $6. However, what we're going to do is we're going to take our $6 risk and we're going to reduce that by $6 by finding a call option up here that we can sell for $6. All right, and this, if I buy a put for $6 and sell a call for $6 at expiration, even if the stock is at 0, what happens is you didn't lose money. And people are going to say, I don't see it, I don't get it. So let me kind of show it to you right now. If the stock were to go to 0, how much do you lose on a stock? 50 points. Okay. Now, however, on this side here, on the put side, if you buy a $50 put, you have a right to sell it to the stock to somebody at $50. Okay, so you will actually get $50 here for selling the stock to somebody, but you paid $6 for that right. So you're going to subtract that out. Really, your break even on that part of it only is $44. So if you don't sell a call, you got a $44 break even on the put side. However, what we're now going to do is we're going to sell the call option for $6. So you're going to get $6 back, and lo and behold, we pulled a Houdini. We're back to 0. Okay, we didn't lose anything on this trade. And the only reason that works is because, and like I said, we're getting a little more advanced here, is because we are financing this put with a call option of the same cost.
So going back to the car analogy, George, I'm looking for a new car. I'm looking for a sports car. I'm going to go out and buy the new Dodge Viper. Okay?
You?
I'm going to buy the new Dodge Viper.
Okay.
So I'm looking at the Viper, and then I'm going to insure it, so I'm basically buying puts against it.
That's correct.
Now, I guess to finance it, I need to come to you and take the money from you to pay for the insurance. And I've created a collar on a car.
That's right, exactly.
Okay.
Well, I don't think that deal's going to work.
I don't think so either.
Anyway, so really what Tom's saying as an analogy is you buy a car, you have to buy insurance. That's what most states mandate. Okay, $1,000 a year. You have to take the money out of your bank account to pay for that insurance, where we can get it from the market. So that's kind of a cool concept. Right. It's like somebody else paying for your insurance.
That's exactly
a pretty good analogy.
That's exactly what it is.
That's a good analogy. Anyways, so what you can kind of see is we're going to hold an asset called a stock. We're going to buy a put, sell calls. It's only a 3-step process. So we're going to do the protective collar. So if you already own a stock, and I know a lot of our viewers already own stocks, and you're bearish on that stock, but you don't want to get rid of it for whatever tax reasons, or you've owned it for so many years, all you're going to do is buy a put option and sell a call option to finance that put option. Now, we have to also decide which calls and which puts. There's a ton of them out there to do, right?
Right.
So the viewer out there is going to say, well, there's a lot of strikes, there's a lot of years, whatever. What we're going to try to do is to kind of show you what we're going to do in most cases is we're going to use longer term options.
That's right.
We're going to use leap options. And remember, leap options are options with more than 9 months to expire. Okay? And the reason we do that is because there's a couple reasons. One is because, we want to have a cheaper put for protection on a daily basis, but also they usually add a skew to the call side. Why do they do that, Tom? Why is there a skew ever over there?
Well, once again, the calls, the calls have infinity to go to.
Right.
I mean, you're betting bullish and there's no ceiling, where puts have a floor to them. And the other thing that happens, too, is in stocks that are actually volatile, which this works in really well, by the way, is high volatility, is that the higher the volatility, you know what's happening, the more press that this particular stock's probably going to get on TV. The more press it gets on TV, the more that people are going to just insist on buying, on either buying the stock or buying calls or selling naked puts.
Sure.
And all this buying calls demand creates an increase in the call price. And the selling naked puts actually creates a decrease in the price in the offer, because when when a horde of people are trying to sell something, the offer and the bidder is going to actually drop. So that actually creates what's called a type skew, an implied volatility type skew.
Very good. And the way to look at it is if you and I are traders and we're on a floor and you want to sell, you want to go ahead and sell a call option to the year, whatever, 3 years down the road, right, or 2 years down the road, we're not going to know what the price of that stock's going to be, but it's probably going to be higher. So we add our own volatility skew to that. And it's kind of interesting how that works. In fact, this is one of those strategies, like I said, that institutions will use if they really want to protect the portfolio. Okay. The other thing is, that's a protective collar. You own a stock, you want to protect it, buy the puts, sell the calls, and you know what? The stock goes to zero, you're not going to get hurt.
I found out the first time I figured out that there was actually a skew in collars was I had a good friend of mine who used to be a trader, in Chicago, and he left the world of high stakes trading. At least for him, he was a high-stakes trader.
Okay.
He wanted some lower stress, so he decided to go work for a .com company.
Right.
That's very ironic that he would get lower stress out of there. So he's working for the company, and he's given stock. His stock is going up like crazy. Everybody's in the company is going up. And he started thinking, you know what, I've got to protect myself because I used to be a trader. I know exactly what's fixing to happen. But he didn't have his stock for more than 6 months, and he wanted to hold it for a year to at least get the capital gains.
Sure.
So you know what he did? He put a collar on, and he sold, and this is how he protected it. The stock was at 200. He bought a 200 put, a long-term 200 put, and sold a 200 call. It just made it real easy. And what he found out was he actually got a credit for the position because the calls were more valuable than the puts that he bought. So he put this together. Anyway, the moral of the story is, what goes up comes down. What actually happened was the stock went from 200 to 5. On its way from 200 to 5 because the other employees in his company were just margining their stock to buy more. They were getting more and more greedy. Right. Well, they all got margin calls halfway down to zero and wound up getting their stock taken away from him while he had his collar at 200, so he got to actually, what he wound up doing was actually exercising, this was really neat, he exercised the puts, which allowed him to sell the stock at 200, long-term capital gains because he did it with a longer time frame, so he let his stock, he held his stock through that 12-month period. And so it became a really neat tax advantage. And of course, you want to check your CPA to make sure what's right in your circumstances. But this worked real well for him.
Yeah, exactly. I mean, what people have to understand, this is a very advanced strategy. I mean, this is what the institutional options traders do. So, as you get to this point, you got to realize, we're giving you, what we think is some of the best strategies. And then there are various versions of these different things we can work on. So we're going to give you the best that we can teach you here. But let me give you a little clue here. Remember what we've done by buying a stock, buying a put that's at the money, you are actually paying $6 of time value here. Okay, so you got to look at it from the standpoint of I bought $6 of time value, that's what I'm going to lose. So what did I do? I sold $6 of time value. And that's pretty much what a collar is. And remember, Tom's mentioning the appreciating type collars are stocks in the news, volatility is high. There's a volatility skew between the puts and the calls. Where do we find that skew again, Tom?
Optionetics.com.
Optionetics.com.
And again, too, guys, is that, when these stocks are in the news, what's going to happen is the supply-demand thing is going to be created by the novice traders, the ones that don't or aren't using the strategies that George and I use, and they're just simply going out there and buying out-of-the-money calls and creating more of a demand on the offer side, and they're selling at the money to out-of-the-money puts and creating more of demand to the downside. So what we can do is we can take the same outlook with them. We'll just take the outlook by buying the stock and buying puts for protection and selling out-of-the-money calls and trying to get the same price for the out-of-the-monies that we paid for the at-the-money puts.
Yeah, exactly. Well, let me kind of show them how do you make money on this thing, because people are like, wow, that sounds good. I protected it.
All the time.
I protected this. Do I make any money? That's great. It's fun to put on a trade, but if you don't make any money, well,
that's right. Might as well stick your money in the bank.
Yeah, might as well work somewhere else.
That's right.
So anyways,
that's right.
Anyways, let's take a look at this and see what I did. Let me give you an example. Let's say the stock was at 50. This is the stock price, and I go and I buy the 50 put. Okay, let's say 2 years to go. Okay, give myself a leap option, etc. And let's stay with the $6 example. I'm going to then go up and I'm going to look for a call option selling for $6. Using the same expiration month, I don't really have to, But if you're going to look for a different one, don't. The best thing to do is you got to remember, if you're going to buy a stock and sell a call, what is that? That's a covered call.
That's right.
So really, if you're doing a covered call with a protective put, in many cases you can play with the different expiration months, but it creates a different risk curve.
It does, and I think you should just keep it simple to start out.
Let's keep it simple. But if they get to learn how to use our website, they can massage the trade.
Absolutely.
What I mean is change the expiration date, see how it affects the risk curve, and they could definitely do that. And let's go ahead and we sell. Let's say we sold the 65 call at $6. Okay. Now, when I put all this together, if you look at my example, I have this is a zero risk trade because I have a right to sell the stock for $50. I paid $6, but I got my $6 back. Now, where do you make your money is in this here. It's called the bracket. We've created a 50-65 bracket. Okay, that is your collar. The bracket equals your collar, because you have now told somebody, I'm going to sell you the call, but I have to now deliver the stock to you at $65. So you can only make from 50 to 65 on here. If you created this bracket, remember what you got to do. How much is your cost to get into this trade? Since most of you are using margin accounts, and if you're not, it's a different calculation, but you're going to put up $50 for the stock, divide it by 2, you're going to put up $25. Okay? Now you're going to pay for the put. Okay? You bought a put, so you're going to pay a premium. So you're paying another $6. However, you sold the call. If you did it the way we did it, these will negate each other. You're back to the cost, half the price of the stock. Now you're going to say, well, I got to still buy the stock, and I'm going to show you there's a couple other things to do other than buying stock. But look, keeping it simple, you own a stock, buy a put, sell a call against it. In this case, your investment is $25. Okay?
That's right. And depending on your broker, it could be less than that.
Okay.
Due to the margin requirements now set on leaps.
Sure.
So actually, you could that leap put that you're paying for, you may only have to come up with about 2/3 roughly.
Sure.
And then that would even drop your cost even further still.
And margins change all the time, so you need to look at it. So
Exactly.
keep an eye on it. Talk to your broker about trying to do these things, because they'll kind of understand what you're trying to do, and you can ask them, what is the lowest cost way for me to do this? So I've got an investment in this trade of $25. So my investment is $25. Now, where did we say that the most we can make? We can only make our return. The maximum return on a collar is the bracket. So the bracket amount there was 65 minus 50. I can make $15 on this investment. Now $15, so if I can make $15 on a $25 investment, that's a pretty good return. What is that number anyways?
Absolutely. It's in the high 60s.
66%?
66% looks good to me. And then the other thing is if this was a 2-year option, roughly it's going to be 33% per year.
Sure.
Where else are you going to find a 33% per year return on investment with no risk?
No risk if you do it right.
If you do it right.
You got to do it right, though. So bottom line is, we're looking at this is really a no-risk trade or low-risk trade, depending how you structure it.
Right.
But, I mean, it truly is. If you did it right, it could be no risk.
Yeah,
if you wait to expiration.
The only real risk you have is opportunity risk.
That's correct.
Let me tell the viewers at home a good example that I did in my own account, and that was, Cisco was running really high in the 90s, and for whatever reason, I decided I needed to add that to my portfolio. And, I bought Cisco at $65 a share,
right.
which the high was 80. And so I saw it going up a little bit, but then soon after, it had dropped down into the teens.
Yep.
Well, luckily, what I did, putting this trade on, I've put this trade on. I bought the at-the-money puts, and I sold the out-of-the-money calls, and I bracketed it up real nice.
Right.
I was set up for a real nice return. Mm-hmm. What did Cisco do? Fell apart.
Right.
All right.
Okay.
Luckily, what had happened to me? Nothing, because I was collared.
Sure, sure. We have a number of our students come up and say, hey, the best thing I ever did and learned from your classes was doing collars on all my stocks that are down 90%. I mean, every stock, as someone said, every stock I had just got hammered, and I'm not losing money, and it's a wonderful thing. However, you can make money, if you think about it, if you made 20% a year, risk-free, wouldn't you be pretty happy? Even if it was 20%?
Extremely
I mean, the whole world would be. I mean, that's believe it or not, that's a really good return. If you think of Treasury bonds. Treasury bonds, you're getting, much lower rates than that. So bottom line is, it's a good way to make money. And this bracket, remember, this bracket will determine how much you can make, which is the return portion of the trade, and the investment portion is really everything you've put together. Okay, so if you go back to your regular collar, no matter what kind of collar, appreciating collar or protective collar, you're creating a bracket. If you put the bracket in too close, if you did a 50, a 60, 65 bracket, there's no money to be made.
That's right.
So you want to keep the bracket certainly enough that you can make at least 20-25% a year, wouldn't you think?
I agree, and I think to keep the brackets real wide, what you got to look for is stocks that are in the news, that everybody is trading. It could be a stock that's going up fast or going down fast.
Right.
Regardless of where it's moving, the volatility is high.
Sure.
The options premiums are allowing you to set that bracket nice and wide.
Sure. But if you have stocks right now that you want to protect, you can still do it. Just realize you're not going to keep the brackets too far, away from each other. So you got to remember, it's a very important. It's an easy strategy, believe it or not. It's not that hard to do. It's just you got to learn all the different things you can do with it. There's a ton of things we can do with this thing too.
That's right.
Once as you get, as you become a collar expert, so to speak, and you learn how to use the risk graphs on our website, you'd be amazed at what we can do there. Okay. Yeah. So basically, remember the net cost of this is the stock price divided by 2. They're going to add your long premium, subtract your short premium, which is what we did. In our example, 50 was the stock price divided by 2 was 25. The long put was 6. The short call was 6. Next, the maximum reward is the amount of the collar. Basically, we've collared it. We put that bracket from 50-65. The risk is none if you do it correctly. Okay, right. You wait to expiration, everything goes bye-bye, etc. But you know what? That's
the only risk that I see is inflation risk or an opportunity risk, but not directional risk.
Sure, and then pretty much the break-even. Your break-even is really the stock price. But if you happen to have, if you did a 50-50 stock with a put, if you happen to have taken a credit in, it's actually lower than you would reduce that from the put strike price. If you took a debit, then basically it has to go higher for you to make money. So you would add that debit. So once again, the long stock, if you take a look at your screens right now, has the unlimited reward proportions, but it also has the risk of the stock going to 0. What we've done is cut it off dramatically. And if you look at what a collar risk graph looks like, done right, the 0 line, which is the horizontal line, it will be no risk if you do it correctly.
It actually looks like a bull call spread with no risk. That's what it looks like to me.
That sounds pretty cool to me. So, okay. So anyways, how would you enter a collar order? There's actually a couple ways to do it. First, if you actually had the stock already, all you had to do was enter the other part of it. You want to buy this put, sell that call at whatever the spread is. Or what you can say is, if you want to enter as a collar, you say, I want to buy X number of shares of whatever stock, and I want to buy whatever number of contracts of whatever put we're going to use, and we're going to sell number of contracts of the calls with a limit of blank debit in opening all the sides. Now what that means is a limit of blank debit is going to basically be, if you do it right, half the price of the stock. So right. If you did actually the price of the stock, but you're only going to put up half. So if you did the example we just did with a $50 stock, you're going to go ahead and say, and let's say we did 1,000 shares. Okay, as an example, we're going to buy 1,000 shares of XYZ, and we're going to buy 10 contracts of the 50 puts, going for a long-term expiration period, and we're going to sell 10 contracts of the 65 calls with a limit of 50 debit opening all the sides. And they'll do it as a collar.
That's right. Yeah, I was going to mention, George just said it, let me reiterate that, is that if you have the right broker, they can put that whole trade on as one ticket.
Yeah, it's, people do this stuff. If you can, you can tell them what you want, and whether you get it or not, it's up to the broker. If they know what they're doing, they'll know how to do this, right?
That's right.
Okay. What are your exit rules? If you really want to exit this thing, if the stock is below the strike price, and remember your stock is covered by the long put and the call becomes worthless, you don't really have to do anything, right?
That's right.
You can put a new collar on, okay? Above the stock price, if it's above, your calls will carry away your stock price, okay? And the puts expire worthless. You made your maximum reward.
So I don't have to do anything there either.
No, so you don't have to do anything there because your stock gets taken away. The first example on the exit rule, if it's below, you still have the stock. So right. You can decide what you have, or you basically have something we're going to talk about next, which is long stock in the money put.
Right.
which is we're going to talk about in a second, in just a little bit. And if it's at the stock price, then everything goes worthless. You know, you can certainly sell the stock or keep it and create a new collar too. So there's a lot of other rules, and on top of that, you know, there are ways to even trade collars, which is what we like to teach in our 2-day class too, which I'm going to just kind of mention here. You know, remember, you're creating a bracket here, okay? When you create a bracket, you're creating a trading range. So if I did a 50 stock, price is 50, we have the 50 put, and we have the 65 call. If you didn't want to cap this here, there's certainly ways we can do that. But if you created this bracket of 50, 65, and the stock now has moved to your 65 level, you know, why not just create a new bracket? You know, lock in the price of the stock. How do you create it? Well, you sell this put, right? You buy back your call, and now create a new one. You buy the 65 put, sell the 80 call, okay?
And there's students of ours that actually do this
Yep.
year after year after year, and all they're doing is they're creating actually tax losses with
Yep.
the options,
Yep.
and yet they're still holding their gains as an open position each year.
Exactly. And one thing, as you said earlier, you know, if there's any tax issues involved, do not talk to Tom or me. Because
right.
I was a really bad CPA, by the way. So you know, I can trade, but I was a really bad CPA. So anyways, get professional help.
That's right.
Anyways, also if the stock is going down a bit, remember, if the stock is going to, say, goes to 35, you can then do the same thing. Move the bracket down. You can you can go ahead, buy back the calls, sell the puts, and create a new bracket here. Say now you buy the 35 put, sell, say, the 50 call, okay? So what I'm trying to show you is practices. It's called trading the collar, okay? But even if you just put it on as a simple collar, that's simple life. This, let me tell you, when you learn how to do this, now you're becoming a really advanced trader, okay? You've taken some certain steps even higher than what you're going to do with most people. Most people I know who are professional traders can't even do this stuff. So they're not even, you know, nor do they even have the information available to do it. So, you know, practice before you do it, correct?
Right. That's right.
Okay. Anyways, what we're going to do next is we're going to go to a couple other areas that a lot of you probably have never seen before. They are advanced strategies. We're going to do synthetic calls, and then we're going to do synthetic puts. I'm going to let Tom take over at this point because he's my synthetic call master.
We're going to talk about synthetic calls now, guys. And let me just say this. The word synthetic, okay, that actually means, you know, it means that it looks and feels like the real thing, but actually could be something entirely different. See, George here could be wearing a synthetic silk tie, but we don't know that for sure. The only way we're going to find out is if we turn it over. So, looking at synthetic calls, what a synthetic call is it has the look of a call,
Yep.
it has the wrist graph that looks like a call, but its components have nothing to do with calls, okay? Mm-hmm. So what I want to do is a synthetic call. I want to talk about what it is real quickly. It's actually it is a combination of buying the stock and buying a put. Okay? And what I want to do is actually take it a step further and actually want to buy the stock and buy an in-the-money put. And the reason why is because as you've learned from the first tape when we talked about in-the-money, at-the-money, and out-of-the-money options, that the in-the-monies and out-of-the-monies have less time value. Yep. Okay? Now, if I actually go out of the money, then the combination is going to have some risk in it between where the stock price is and where the strike price is for the put. If I go into money, I'm adding real value to the position, and therefore what I'm doing is I'm actually cutting my risk down to just the time value in the put. Yep. So if I go deep enough into money, I could erase most, if not all, the time value.
Right. So you're saying that if the stock, for example, the $50 stock, if we buy the $50 put, it's mostly time. It is time value because there's no real true intrinsic value. If you go to the $60 put with a $50 stock, you've got mostly intrinsic value, which you don't lose over time.
Yeah. The example that you gave here is actually a real good one. If you were to just buy the puts. Right. You know, when you put together your XYZ trade and you bought $50 stock and you bought $50 puts, well, you paid $6 for those puts.
Right.
What if we bought the 60 puts and we were able to buy the 60 puts for, say, 12?
Right.
All right? Now what we've done is we've actually created 10 points of real value and now only 2 points of time value versus the 6 points of time value when we were at the money.
So, in essence, let me draw that out for them because I'm Mr. Drawing here, you know.
Okay.
I'm a frustrated architect because my brother and dad are architects. They can really design good things, but I can never do that. So.
And we're letting George draw this because I am a frustrated pharmacist who you can't read anything I write on a
Okay,
pad.
so let's kind of show you what we're talking about. The stock is at 50, okay? That is your asset. The first example we had the put at 50, okay? If the cost is $6, this is all time value, correct?
That's correct.
But remember, we got rid of that time value on the collar by selling a call against it. This time, we're not going to sell the call against it. Now, what Tom said is, hey, why not get a put up here, put at 60? And sorry about my, okay, 60, okay? And that cost is $12. What he's saying is, well, out of this, we have $10 is intrinsic value and $2 is time value. And all you're going to lose is the time value over time. You don't lose the intrinsic because if the stock happens to move up, you make on the stock and lose on the put.
Yep, and now I'm going to show you how to actually cut out the $2. Let's get rid of it. We're going to talk about how to actually drop that down even more. We can do it one of two ways. We can actually keep increasing the strike price of the put until we eliminate all the time value. The problem is that when you get really that far up, you could run into a liquidity issue because you know you get that far up in the money, that deep in the money, there may not be a whole lot of buyers and sellers up there.
Right.
So we're going to stay close to the money, and I'm going to show you this particular strategy works really well with dividend stocks because we're going to have the dividend help pay for the time premium. So here's an example I want to use, and now I'm going to write on this as best I can.
All right.
Let's start with Philip Morris. I actually wrote an article which is on our website on Philip Morris on this past example I'm going to give you.
Okay.
Philip Morris was trading around $20. Okay, $20 a share. This was back when they had some problems, some legality problems. There was a lot of litigation going on about smokers' rights.
There's
and,
litigation going on?
Oh, absolutely. So anyway, what this caused was this caused a $50 stock to drop down to 20. It actually went as low as 18. So I mean, we're looking at this. It's being touted in the news. It was on a Tonight Show. Jay Leno was making comments about Philip Morris. And when Jay Leno has a news story, everybody knows about it. If you didn't catch it on CNN, you catch it on a Tonight Show. Now the entire American public knows what's going on. In fact, I think more people watch the Tonight Show than they do CNN. So that I'm using that as my catalyst for taking this trade. Is that everybody knows about it? It's a beaten down stock. All right, one thing that as it got beaten down, one thing that got higher was the dividend yield. This stock actually paid, and still does at this time, a $2 per year dividend. Okay, that's compounded. It's about 48 cents a quarter, so we're adding a couple of pennies on for compounding. But basically, $2 on a $20 stock equals a dividend yield of 10%.
Okay.
That's high.
Sure
That's
is.
extremely high.
Yep.
Okay, now, we don't know whether the stock's going to keep dropping or not. All I know is that I got a big dividend there, and I also have a strategy, which is a synthetic call, and I could create a strategy that can take the risk, the time value out of the position. So what we're looking at doing is to create any synthetic call, you're going to buy the stock. Okay, and I'm going to put out here 100 shares. Okay, and for every 100 shares, I'm looking to buy an in-the-money put.
Just one.
Just one.
For every 100
That's right,
shares.
one for every 100 shares. That's correct, George. And so,
really?
Yeah,
I got
absolutely.
that right? Okay.
Man, you are the master at determining
Jeez,
stock to contract.
Okay.
Okay, so let's say we're gonna buy this stock at 20. All right. I'm looking at an in-the-money put. Well, the first in-the-money put I'm going to go to is the 25 put. Okay, so the 25 put at this time was trading for about 7 points.
Okay.
All right, so if we broke that down the way you do, then the intrinsic value, there's 5 points of intrinsic value, and the time value is going to equal 2. Now, if this was any regular stock, I would know that my risk is the time value in a position because if the stock price goes up, the puts go down. If the stock price goes down, the puts go up. It's almost like they're at constant battle with each other to keep this trade right where it is. Now, over time, I'm going to lose that time value of 2 points. So that is my risk in this particular trade. Now, let's go look at this $2 dividend that we got here. And if we buy this in-the-money put, by the way, which has a year to expiration, I'm going to take in $2 in dividends over that year. So I'm going to drop my $2 in dividends down, and it's going to cancel out or take care of this time value.
Very good.
So now I have a trade, and let me throw out a risk graph up
Sure.
there so everybody can see it.
Sure.
Now I have a trade that actually has no risk. So what I want to do is I want to show you where you can actually make the money, because when you look at it, a lot of our viewers have never seen this before, and they're thinking, okay, all right, I understand if the stock goes to zero, the 25 puts are going to be worth 25, and I'm going to take in a dividend of 2, which is going to pay for my time value. So they may understand that concept, but how do you actually make money on the upside? Okay, our stock price was 20, so I'm going to put SP equals 20. Remember, our put that we bought was a 25 put. Now, we had dividends over here that equaled $2 per annum, and we also had, of this 25 put, which was 7 points, the time value equaled 2. So to make this real easy, this is basically how you put this trade together. It's a synthetic call. That means it looks like a call option. Okay, a call option looks just like this, and your risk is actually just the time. So I had 2 points of time here. The cost of this trade is actually going to be the stock price plus the put price. So your cost is actually going to be 32. So to put this on, you're buying the stock for 20, you're buying the put for 7. Okay, your total cost is going to be 32, but that's not your risk.
Right.
Because as the stock goes up, the put goes down. As the stock goes down, the put goes up. Your real risk is going to be 2.
Your time value.
But looky here. We've got 2 points of dividend, which is going to raise the bar on this risk up to break even. Now, if that's the case, my new risk graph is going to actually look like this. It's going to come across in blue, and it's actually going to go up. So that's my new risk graph. So where do we start making money on this trade? Right here. Okay, what strike price did we use? We used 25. Even though the stock is at 20, the position doesn't really start to increase in value until we go over 25 at expiration.
Sure.
And then from 25 on up, you know, the ceiling is your friend.
But even before it gets to expiration, you'd probably make money, because as a stock starts coming towards that put price, you start building time value up.
Exactly. And I'm going to put this in, let's use another color here. And this could actually become the risk graph for today.
Right.
And another thing that George mentioned is, how about this? Time value is exponential, meaning that you lose a little bit in the front few months, and as you get closer to expiration, you wind up, that's where the bulk of your time comes in. Well, guess what? Dividends are not exponential. They're going to pay you that 50 cents every quarter. So you get your first dividend, this thing's actually going to boot up above 0. And so, you know, it could actually become profitable in the first quarter. It's a really neat concept. I really love this.
You're a smart guy, Tom.
I'm telling you.
I'm impressed.
So you know, and let's just look at where Philip Morris actually wound up going. Okay. It's actually it's gone above 50.
Taking off.
You know, a year later, it's gone to 50. So you're talking about a stock that doubled in value. So you've gone from 20 to more than doubled in value. You took a position that costed you 32 points that you actually could trade out. At the time it was trading for up to 55 at one time for 50 points. So you take your 50 minus 32. That's going to give you a profit of 18. Okay, so that's quite a nice reward. But you know, again, this one has unlimited risk. This doesn't have just the limitation. It doesn't have the collar on it, because instead of selling, we just financed unlimited reward.
Yeah.
We financed, instead of selling a collar, we financed it with a dividend.
Right, exactly.
That was the big difference.
That's good.
And the dividend doesn't cap you to the upside.
Okay.
So let's get back to the entry rules on synthetic calls once again, and you'll see what I've been doing here. Number one is I'm using dividend stocks. I'm using stocks that actually pay a high dividend, not the low dividend. So you got to look at stocks that pay high dividends. What kind of stocks pay high dividends? Well, I classify them into 2 categories. Something that always historically pays a high dividend, which is like a utility company, gas, electric companies always pay a better than average dividend. And then you've got that worst performing stock, where the dividend stays the same, but because the price of the stock has dropped, it's increased the yield. Okay? So I call it the out of favor stock, the worst stock of the world of the year award. Okay? Low implied volatility works real well, because that means your time value is going to be less. All right, and also we've used the long-term options just like collar spreads.
Sure.
We're going to use leap options.
Excellent.
All right,
very good.
The cost of the position is going to be the stock price plus the option, the cost of the put. So you got to put those together. That's your cost. Yep. Next is your maximum risk. Your maximum risk is going to be the time value on the trade. And what we want to do is we want to use something like dividends to help pay for that time value, so you can bring that down to a level where you could actually have no risk on the trade. Now, the real risk that you're going to run into on one of these, and I have to explain this, is that what if the company cuts its dividends after you put this in? Okay, I can think of AT&T, which used to be a dividend stock, and they cut their dividends recently, and so all of a sudden now, if you would have put one of these on an AT&T and then they cut their dividends, now good news is usually when a stock cuts its dividends, it causes a jump in the stock price short term. So you can actually just get out of the trade and really not have a whole lot to lose there except maybe slippage.
And companies cut their dividends because they want to use the cash flow for something else. They may need it for additional growth.
It increases shareholder value, which is what causes that jump in the price. Maximum reward we know is unlimited because this is a synthetic call. And the break even, again, the break even is going to depend on this factor right here, which is your dividend and your time. In this example, the break even would be is going to be 2 points above 25, which would normally have been 27 would be my break even. But because we use the dividend, that reduced the break even back down to the strike price.
So once again, the time value is what we amortize. We call it amortize. We got to pay for it. So, but if you go too deep in the money, the stock will never get there or may not get there. So that's why you try to pick, a reasonable point to buy that put.
That's right. Now I'm going to show you an example, another example, and what we're going to use a totally different stock. Same thing though. It's been beaten down by the public. They've had some problems. Again, they're also in some litigation problems as well. And this is Ford Motor Company. All right. Ford Motor Company is a big company. One of the big three automakers. They've got lots of cash. Actually their PE ratio at this time is half that of the automotive sector. Yet they're still cranking out this, basically the same kind of sales. Now, what we're looking at doing is taking Ford, which the symbol for Ford is F. It's a one-letter symbol. I like one-letter symbols because they mean boring. Boring is one-letter symbols. So I'm going to take Ford, my one-letter symbol, and the stock's trading around, at this time, is $25. And we're going to take the stock, so we're going to buy, and I'm going to write this up like you did, George. I'm going to buy the stock at 25. Now, I got to buy an in-the-money put for protection. Ford pays a dividend. Not as good as Philip Morris. They pay a dividend of about $1.20 to $1.30 per year. Now, their dividend, let's say their dividend is $1.30. I've got to go up and I've got to buy a put. So I'm going to go up to the next strike price and I'm going to buy the 30 put. The 30 put is trading right now at 6 1/4. Now, this is a 1-year option. That means we have a year to expiration. So, my intrinsic value between 30 and 25, this would be my IV intrinsic value is going to equal 5. Now if I take the 625 minus my intrinsic value, I'm going to get a time value equal to 1 1/4. All right? It doesn't take a rocket scientist to figure this out.
Which is really the risk. The time value is the risk, and even if it didn't pay dividends, that would be the risk.
That's
right. You're going to get rid of it. So.
Yeah, we just got rid of a lot of time value just by going to an in-the-money option. Now we're going to get rid of the rest of it by allowing the dividend to pay for time value. So now we've created a trade where we've gone ahead and capped all of our risk. So now it's just a matter of, okay, what does the risk graph look like? The risk graph looks exactly the same as the Philip Morris graph. Just draw it out real quickly. And again, without putting in anything, I'm just going to ride this break-even line, and I'm going to spike up. And the area where I start to make money is at 30 or above. Okay, that's at expiration. Now, George had mentioned before that what about today? Today you're going to have the graph look more like this. It's a really neat graph, and this comes into play with dividends, and also the fact that time doesn't decay as rapidly in the first part of your trade as it does in the back part of the trade when we get to 30 days to expiration. So again, this is a really neat strategy, and it's also called a married put, okay? And the way you call this in is you can actually call this in as one order, okay? You can call it as a married put. You want to tell them it's a spread order, and you want to buy, X number of shares of stock. Okay, so if I'm buying 1,000 shares of stock, what am I going to do to cross this position? I'm going to buy the whatever strike price puts I'm going to do, and it's 1 put per 100 shares of stock. All right, and I'm going to pay a debit for this. Okay, because I'm going to buy the stock and I'm buying the puts, so I'm taking the cost of the stock and the puts, putting it together, and that's going to be my price opening both sides. Okay? Exit rules for synthetic calls, it's very simple. This is more discretion. And what it means is that if you think, for example, with Ford, let's say you've done some technical analysis, you've done some fundamental analysis, and you're looking to see where you think Ford is likely to go to. And let's say you think Ford's going to go to 40 by next year. So it's going to go up 15 points. Well, if Ford hits 40, no matter how much time value you have in the trade, you know, the best thing to do is exit.
Right.
All right?
Exactly.
But because this trade, you've capped all the risk, the exit rules are very simple in that you're really exiting if you have a profit. If you don't have a profit, let's say Ford drops to 10. The best thing to do is let the trade expire, and then the puts are going to carry away the stock.
Okay.
And now you've basically, the options have actually exited the trade for you. So that's synthetic calls, and now I think George is going to talk about the other side of the coin, which is synthetic puts.
Synthetic puts. So you know if there's a synthetic call, there's a synthetic put. Anyways, this is something you don't want to do at home without adult supervision. You know, this is a very aggressive approach, and I'm going to tell you when I usually do this thing. This I usually do going into expiration periods. The reason is, you know, if you sell a stock short, you don't want to do that, especially if it pays dividends.
Oh, yeah. Don't do it on dividends, folks, because you're going to be paying the dividend if you sell the stock short.
So you don't want to do that. What we're trying to do is find stocks that are weakening going into expiration period, and what I'm going to do is sell the stock short. Okay, because I think maybe the market's going down. I think this thing is weakening. And I'm going to just go ahead and show you how this works out. Let's say I sell a stock short at $32, okay? And let's say I sell 1,000 shares short. What that means is I have unlimited risk if the stock goes up, if I'm wrong, so you don't like that. So what you're going to do is do very similar to what Tom did in synthetic calls. What I'm now going to do is I'm going to buy an in-the-money 30 call, I'm sorry. We're going to buy the in-the-money 30 call because that gives us the right to buy the stock from somebody at 30. Now, here's the thing about this, and the reason I'm doing it going into expiration is because time value is getting sucked away. And I might do this going into the last week before the expiration, which is the third Friday of the month. And what I'm going to do is buy the 30 call. Let's say I pay 2.25 for this because all the time value's been sucked away. It's deep in the money compared to where the expiration period is. Really, what you've done here is you have bought $2 worth of intrinsic value and 1/4 of time value. The only risk you have on this trade is the time value portion. If you bought something with real value, because what happens now is the stock goes to 100, who cares? You're going to lose your $0.25 because you're going to exercise your $30 call, and you know what? You lost on the stock, but you made on the call, dollar for dollar, so it doesn't matter. Now, on the other hand, if the stock does break down, okay, tumbles through 30, going to expiration because that weakness did come into effect, you're going to find that the stock could just break down, you took $0.25 worth of risk, and the thing just fell apart dramatically, okay? And you can make a lot of money doing this if you catch the right stocks. I mean, I can tell you there's times where I've done this or tried to do it, and, you know, sometimes I'm a little too cheap on trying to get the time value portion, and the next day you're like, I should have done that. I should have done that. But this is, you know, for aggressive moves to the downside. You know, when you expect going into expiration, you know, this is for people who want to, you know, you wake up one day, you're feeling bad about the markets, and you want to sell a stock short, which most people never even do in their lives, don't you think, Tom?
That's right. That's right.
You know, most people don't feel comfortable with selling stock short. So this, like I said, this is why it's in our advanced tapes. What it looks like, once again, and Tom did the risk curves, and let me create the risk curve for this one here, okay? If I took that $0.25 worth of risk, you're basically doing a synthetic, okay, in this case, because how much can I lose on this trade? We said $0.25. You're going to make money because that's my time value. Okay, so that's 25 cents. Remember, you make money on this trade in which direction? On the way down. So what you're going to do is have a risk curve that looks like this. Okay? And what happens is this will be your strike price here. In this case, it would be the $30, and this would be your break-even point. So how do you figure out the break-even point? Remember, the way you do this, the way you enter the trade, will be your cost of your stock going short. But remember, that's a credit. So if you sell a stock short, you know, for $30, that's actually a credit. So I would have a $30 credit, okay? And now I have to buy the call option. If I buy the call option for 2.25, what they're going to put, you're basically doing the trade for 27 3/4. Is that a debit or a credit? Credit, okay? All right. So what you're expecting is a major move to the downside because you're buying the stock, taking a credit in, and then you're going to have a debit. Okay. The maximum risk on this is the time value when you do it right. So if the deeper in the money you go, the better off it is. But I don't like to do this unless it's going into expiration, going the last couple days or maybe in the last week. Your maximum reward is basically all the way to the stock going to zero. Okay. But most stocks aren't going to go to zero. But boy, if they're showing weakness going to expiration, sometimes they get really hammered. Okay, so what you're going to then do is your break-even point is you've got to go in there and look at where you did the put and then subtract the time value because you need it to break through that point in time for you to start making money on these. Okay, these things, for example, this example I gave you is really an example that I've seen, actually I've done before in the past. How do you enter a trade like this? And once again, I said this is an aggressive, really aggressive approach. How do you enter a trade? This is a spread order. I want to buy blank contracts. Remember what we're doing. Let's write it all out. Okay. You're going to buy X number of shares, okay, X number of calls, okay, and you're going to sell X number of shares of, let's say, XYZ stock, okay? And what you're going to do is you're going to go say, I want to buy this contracts of calls. I want to sell these X number of shares, and this is the credit that I want for the trade. Okay, what it looks like, and let me just show you that graph of what we were just doing here. If we sold stock at 32 and we bought the 30 calls at 2 1/4, remember we said the risk is only $0.25. So let's go ahead and show $0.25 worth of loss, or 25 cents, and this is what it looks like. It'll look, okay, it looks like a put, basically, because it's called a synthetic put. And remember, the whole point of this is you're going to get a credit, so your cost of the trade is going to be the credit on the sale of the stock. So in this case, we got a $32 credit, and then we're also going to be paying for the call option. So you got to subtract that out for 2 1/4. You got a 29 3/4 credit. Okay. So you want the stock to be below 29 3/4. That's going to be your break-even point. So the call strike minus the time value that we paid on this will be the break-even. The risk on this trade is the time value, okay? And the maximum reward to the downside, it's unlimited to the downside, basically to a stock going to zero. Because I haven't found a stock that goes below zero yet, have you?
No, not since the 60s when they were accessible.
Some of them we probably owned in our early days felt like they went below zero, right? So anyways, that's what a synthetic put looks like. It's, like I said, it's a very aggressive approach. And remember, the break-even on this is your call strike minus your time value. But the way you look at it is just, you know, when you sell the stock short, you've got your credit, and then you're going to have a debit for the call. How do you call this thing in? I'm doing a spread order. I want to sell blank number of shares of stock short. Make sure to say that I'm going to sell the stock short because you got to get approval for that. And then buy X number of contracts of whatever calls you're going to do with a limit of blank credit opening both sides. In the example we did before, we're selling the stock at 32. We're buying the calls at 2 1/4. Therefore, our credit was 29 3/4. Exit rules. Remember, I'm doing these a lot of times going into the expiration period. So depending on where it really did on expiration is what my exit rule is going to be. If the stock, in fact, let's just do my graphics here. If the stock went up from the point I did it, I blew it. My selling stock short didn't work. I'm going to lose the time value. So what I would do in the example we did, if we had bought the 30 calls and we sold the stock at 32, you know what? You don't have to do anything. Because you're going to get, you can exercise your calls. It'll cover this here. You're out of the trade. Okay.
And with only a 1/4 point loss.
With a 1/4 point worth of loss, which once again is your time value. However, if for example you were right, you sold the stock, and the stock did go down 32, and you buy the 30 calls, what's going to happen is, and let's say your stock's now at 28. And you caught this sucker going into expiration, what happens is your call is going to expire worthless, so you're still going to have short stock. So what you want to do going into the close to get out of it, you don't want to hold this over because this was a short-term trade in most cases, and you want to get out of the stock. What you're going to do is you're going to say, in fact, I'll write it at the very top, buy, whatever number of shares. Let's say we did 100 shares, okay, of XYZ MOC, okay? Okay, buy 100 shares of XYZ MOC, or whatever number of shares. If you did 1,000 shares, you're going to buy these shares on the close. The MOC order, just so you know, is called a market on close. Means you're going to do a market order on the close. On the last ticks going into the close of that day, they're going to buy the shares, you know, that you're short, so you'll have plus whatever the number of shares you bought against the ones that you shorted. You're out of the trade. You're flat, which is what you want to do.
I think of any market order, market orders on stocks, market orders on the close are probably the best market orders to do. You know, we discussed that we don't like market orders, but that's on option trades. Market orders on option trades equal major slippage.
Okay.
Market orders on stocks, you can actually put these on with the right stocks, and you have very little slippage.
Yeah, just before we go on to the next tape, what I would like to do is also assert one more point when people are doing collars or any other type of trade. Remember, the whole point of a lot of the things we did was to control an asset. The asset in this case was stock. Okay? Remember, there are other ways to control stock. You know, in some cases, you may want to do a deep-in-the-money call instead, okay? Which means that instead of buying a stock, you might want to do a deep-in-the-money call. You're not going to get dividends when you buy a call option, or there could be other instruments along the way that get developed that is just another way to control the stock. Remember, an asset, you're going to try to find the cheapest way to control the asset, right? And that's one thing you want to do whenever you're looking at is try to bring down your costs whenever you're doing everything, okay? What we need to do, remember, is when you start using advanced strategies, you know, this is very advanced stuff. I mean, this is stuff that you and I learned, over, all the years we've been trading.
That's right.
And we don't see a lot of people doing all this. So, please feel comfortable that these are a little more advanced. You want to repeat, viewing these things over and over again, okay? And you want to keep looking at this stuff until you got it right, okay?
That's right. And for those of you that have been watching tapes 1 through 7 in sequence, we congratulate you.
Yeah,
especially on your persistence of watching these tapes. But, again, like I said, we have really put together our best stuff through mine and George's 30-plus years of experience combined to really get you what you need to know so that you can come out of the gate immediately. The one thing that we're not sure of is how well your stock picking ability may be, and whether you're a non-directional or directional trader. If you're going to be a directional trader, what we've designed here can actually cut your risk down to even 0 in some cases. But if you're going to make money, you got to have an assumption or have some sort of belief system of where a stock price is likely to go.
Sure.
So if you are in need of trying to figure out where a stock is likely to go, then you're going to want to watch tape 8, which is how to find the best trade or finding the best trade.
Sure. So what we've really done up to this point is we've given a lot of strategies, a lot of ideas, which they don't have to know all of them. They don't have to be an expert at everything. So what we want you guys to do is really go in there, find one that you like, you feel comfortable with, and then apply tape 8 is, how do you find the stocks that fit these strategies? And then we think that's going to accelerate your learning curve dramatically.
We're going to show you a couple of rules. I mean, there's in fundamentals, there's so many different fundamental indicators out there. Technicals, there's got to be 300 indicators at least. And we're going to show you the few that we use that work for us. So we'll see you on tape 8. Happy talking.